Greetings, y'all. How y'all doing out there? Welcome to Liberty Call. Today is Tuesday, October 24th, 2023. Hope everybody's having a fantastical day in the interwebs. It's a better day in the markets. A little green, or quite a bit of green I see on the screen. Looks like markets are less angry today than they were the last few days. But again, be prepared because things could get rocky. And I think we're headed in towards some sort of a bear market, downturn, recession, whatever you want to call it. So we've managed to hold it off since the 2008 and 9 downturn. I know people count that March 2020 as a recession, but when you're going to paper over the economy with $5 or $6 trillion, it kind of undoes everything, and all it does is postpone that problem to today. And now we're having to deal with it again. So anyways, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, yes, you in the black shirt, give me some thumbs up. Like, share, subscribes, follows, press the notification bell. You want to know when I go live. Let's go and get into the numbers for today. Dow Jones up 0.62%, 204 points, closed at 33,141. S&P 500 up 0.71, closed at 4247. NASDAQ up 0.93, closed at 13,139. The VIX fell 7.07 today. It's at 1893. Canada down 0.32, Brazil up 1.12, and Mexico up 0.21%. Germany was up 0.54, the UK was up 0.2%, France was up 0.63%, the Netherlands up 0.35, Spain down 0.22, Italy up 0.05, so basically flat, Switzerland up 0.43, and Portugal up 0.46. Russian exchanges both green today. MOEX basically flat, up 0.04. RTSI up 1.03. And the overnights in Asia, the Nikkei in Japan was up 0.32. Australia up 0.19. New Zealand down 0.07. In China, the Shanghai was up 0.78. The Shenzhen Component up 0.61. China A50 up 0.03. DJ Shanghai up 0.83. Hang Seng down 1.01%. And looks like the Taiwan weighted was closed. All right. So like I said, markets are in a slightly better mood. I'm not sure what they're excited about, quite frankly, because it's a mess out there, folks. I mean, things are going to get bumpy. And if you've forgotten what happened back in 08 and 09, it took a long time for the markets from peak to trough was about a year and a half. So again, looking back, the peak of the market was January of last year. So about 18, 19 months ago. But we've just been sideways most of this year. So we'll see. Again, this could have been the bottom. I don't know. But, better to be prepared and not need it than to need it and have no preparation out there. All right, let's go ahead and get to the market recap for today. The S&P 500 rises as investors eye big tech earnings. We are in the middle of earnings season. All right, on Tuesday, the S&P 500 saw gains as investors eagerly absorbed a wave of quarterly corporate earnings reports, with tech giants Microsoft and Google taking the center stage. Technology stocks continue to rise, building on the previous day's momentum as investors awaited the quarterly results from Microsoft and Google. For Microsoft, all eyes were on the performance of its cloud segment Azure, as the adoption of artificial intelligence was expected to offset modest enterprise spending. Analysts anticipated a focus on optimizing operations as IT budgets remain constrained. Google, on the other hand, was considered well-positioned for earnings, with digital advertising growth supporting its performance in the third and fourth quarters. Treasury yields stabilized following a sharp sell-off the previous day. Analysts noted that this decline didn't represent a fundamental shift in investors' sentiment regarding policy or the underlying economy, but rather a result of larger players adjusting their positions. The 10-year Treasury yield retreated after renowned investor Bill Ackman closed his bet on lower bond prices, citing excessive risk. The FOMC, the Federal Open Market Committee meeting scheduled for October 31st, was expected to result in an unchanged policy decision for next month. Bitcoin experienced a significant surge, rising more than 7% and briefly surpassing $35,000 per coin, a level not seen since 2022. This rally was fueled by ongoing optimism that a spot Bitcoin exchange traded fund, ETF, might soon gain approval. The positive momentum in Bitcoin also lifted other cryptocurrencies like Ethereum and Solana. Several other major corporations provided positive quarterly earnings reports. Coca-Cola saw its stock rise by over 3% as the beverage giant upgraded its annual guidance, attributing the better-than-expected results to price increases. General Electric raised its full-year performance guidance after surpassing Wall Street estimates for earnings and revenue. Additionally, GE announced plans for a spinoff of its renewable energy business, GE Vernova, in the second quarter of next year. 3M Company managed to deliver strong Q3 results that exceeded analyst expectations, leading to a more than 5% increase in its stock price despite recent legal challenges. In summary, the stock market experienced a day of marked by optimism, driven by strong tech earnings anticipation, stabilized treasury yields, and a bullish run in the cryptocurrency market, with Bitcoin leading the way. Additionally, several notable companies provided positive guidance following their quarterly earnings beats. So everyone's in a good mood today. There's always tomorrow. All right, let's dive a little deeper into U.S. business. U.S. business activity ticks up while Eurozone gauge fans recession fears. So everyone in Europe is worried about recession. In October, there was notable divergence in economic activity between the United States and the Eurozone, raising concerns about the possibility of a recession in the latter. In the United States, business activity improved, with the manufacturing sector emerging from a 5-month contraction, driven by an increase in new orders. Services activity also accelerated modestly, with signs of easing inflationary pressures. The S&P Global Composite Purchasing Managers Index, the PMI, for the U.S. rose to 51 even in October, indicating expansion and demonstrating the U.S. economy's resilience in the face of rising interest rates. Conversely, the Eurozone experienced a decline in business activity as demand dropped, causing concerns of a recession. The Eurozone's composite PMI fell to 46.5 in October, the lowest level since November of 20, and well below the 50 level that signifies contraction. The situation presents a challenge for the European Central Bank as it meets to discuss monetary policy. The downturn in Germany's business activity further suggests a recession in Europe's largest economy, while France's economic activity remained in contraction territory. In the United Kingdom, outside the European Union, businesses also reported declining activity, underscoring the risk of a recession. On a positive note, in the U.S., service sector activity exceeded expectations, defying forecasts for a slowdown. Service providers increased prices at a modest rate, and this, along with slower cost inputs, indicates that inflation may be approaching the Federal Reserve's target. I wouldn't hold your breath, folks. These economic trends underscore the contrasting paths of the U.S. and the Eurozone, with the former showing resilience and the latter facing concerns about a recession. Geopolitical tensions in the world, such as the situation in Gaza and Russia's ongoing invasion of Ukraine, add to the uncertainty in the global economy, as mentioned by the World Bank president. So things are kind of, they're not hot, they're not cold. It's just kind of in the middle. So, I mean, the warmongers really want to go to war. I mean, they've been pounding those war drums since last year when the whole Russia thing started up. And, here's another excuse to spend billions and billions of dollars on blowing up people that we don't know. And I really, frankly, I don't want to see anyone die. But anyways. All right. Last up, it's an article from Zero Hedge. This comes from one of commentary from Peter Schiff's podcast that came out, I believe, late last week. So it's titled Peter Schiff, Jerome Powell isn't qualified to be in any economic club. He's referencing Mr. Powell spoke at the Economic Club in New York last week and gave his thoughts on some things. And Mr. Schiff felt the need to chime in with his rebuttal on a lot of this stuff. So, which I agree with Peter on a lot of things. All right. Let's get into this. In a recent speech at the Economic Club of New York, why do you have an economic club? Do they play like pickleball or racquetball? Or I can't imagine there's a golf course in New York City. So what do you do at an economic club? Do you show off your gold and silver pieces to everyone else? And they're like, oh, let me take my monocle away and look at that. All right. Anyways, Federal Reserve Chairman Jerome Powell's comments have raised concerns and garnered criticism from economists and financial commentator Peter Schiff. According to Schiff, Powell is ill-suited for any economic club and is not providing accurate insights about the economy. Schiff began by asserting that Powell is either unaware of what is happening in the economy, or if he is aware, is not being forthright about it. He expressed doubt about Powell's qualifications, suggesting that members of the Economic Club of New York likely have a better grasp of economics than Powell himself, given the rigorous economic knowledge required to join the Federal Reserve. One of the key points of contention was Powell's belief that the Fed needs to weaken the economy to combat inflation. Schiff countered this notion, labeling it a Keynesian myth. He argued that economic growth does not inherently lead to inflation, and that the real issue is not economic growth, but rather excessive consumer spending driven by inflation. To combat inflation, it is essential to reduce spending and encourage saving and investment. Additionally, Powell's claim that the pandemic caused price inflation was criticized by Schiff. He argued that it was not the pandemic itself but the government's response to it that turned a health crisis into an inflation problem. The massive monetary and fiscal responses during the pandemic led to increased money supply, stimulus checks, rising debt, which fueled inflation. So essentially, basically what I've been saying is, if you look at the M2 measure of the cash in the money supply, it goes whoosh, and it just jumps in 2020 when they did all the spending bills and everything else that the Fed did to help us. So I am 100% in Peter's camp on this one. Schiff also pointed out that Powell's dismissal of the role of fiscal policy in the Fed's monetary policy decisions is problematic. Government spending and budget deficits have a significant impact on inflation and monetary policy. The independence of the Fed was intended to allow it to counteract excessive fiscal policies by adjusting interest rates to control inflation. Overall, Schiff's analysis underscores a critical perspective on Jerome Powell's economic understanding and policy decisions, questioning his qualifications to navigate the complex economic challenges of our time. Now, I will give Jerome Powell some credit and some props here. He has actually stuck to what he said he's going to do. I mean, too often, you can look back at Bernanke in the last time we had a financial crisis, and he basically just accommodated everything that the government wanted, as far as bailouts, TARP, all that good stuff. He was more than happy to open the checkbook. And granted, we did not have nearly the explosion in inflation at the time, but we also didn't print the same, percentage of new money into the economy. So, so like I said, Schiff is very critical of Jerome Powell, and granted, he has created a lot of these problems. I mean, it's if the Fed had just said, nope, we're not doing that, it would be irresponsible to print all that money, even though you would really, really like it, Mr. President and Congress and all you folks. But they didn't. And he's, like I said, he's actually stuck to what he said he's going to do. So now also the economy isn't exactly, crumbling like it was back in 08 and 09. So we'll see what happens, 6 months from now when, if we are neck deep in a recession and the markets have dropped 30 or 50% or whatever the case may be at the time. We'll see if he actually sticks to the, keeping rates at or where they're at right now and squishing down that inflation. Even some deflation would be amazing. I personally wouldn't, turn that away either. So, all right, I've rambled enough and gone on for about 13 minutes. So that's everything that I had for today. Me and my boy Jake are going to go out and play some ball in the driveway for a while until he gets tired. And then I'll come back down here and finish up some stuff for the evening. But anyways, hope everyone has a wonderful evening. Astros, unfortunately, I know I waited till the very end to talk about it, but they threw up another stinker last night. They played like crap at home all year. And, I'm not so upset that they lost. I'm more upset that they lost to the Rangers. I can't stand those jackasses from Dallas. So anyways, all right. Well, like I said, that's everything that I had. If anyone needs anything from me, please go to dsafinancialgroup.com. That's where you can go and get all my information, book a meeting, drop me a phone call, or send me an email, whatever you'd like to do. Or just, send me a suggestion on something to talk about. I'm always open to new ideas. All right. Well, I hope everyone has a wonderful evening, and I'll talk to you next time. Adios.